Welcome to Financial Mathematics. So in this session, we'll discuss about cash flow models. So these cash flow models, they form the basis for the financial decisions. So we're going to discuss about the cash flow models, and these they form the financial, like they form one of the important elements or the core elements. As we move along, we will also see about the discounted cash flow modules, which are used for valuing any investment. So understanding the cash flows is one of the important aspects of any investment or any decision process. So that is where we're trying to have a brief introduction of what is this cash flow all about and what kinds of cash flows are associated with what kind of investment. Okay, so just to start up, for any investment decision, what people tend to do is they try to project. They try to project. Okay, when I say I'm doing a financial investment evaluation, my intention is nothing but I will have a projection of all the future cash, inflows. Okay, so let's say I am investing my money, or I have lent, I have gained a loan, I've gained loan to someone for a period of 5 years. As per that loan agreement, every year at the end of the year, that party or that borrower has to pay some interest. And let's say at the end of 5 years, along with the five interest which he has to give us, it becomes a loan amount. So this is what we call a financial transaction. In this financial transaction, there are some places where money is going away from my pocket. Like when I have gained a loan, that means money is going away from my pocket. So money has gone away from my pocket. So when money is going away from my pocket, we call it as what? What do we call it? We call it as outflows. Or in the language of cash flows, we say there is a negative cash flow. Okay, and at different points within 1 year, the person is paying some interest after 1 year. After 2 years, he pays some interest. So there is some money I'm receiving in the form of interest, and probably the loan that has been given is refunded back. So that means I'm receiving. So whenever I'm receiving the cash, so we call this as what? Cash inflows. Okay. So receiving, we call them as what? Cash inflows. Okay. So for any investment or any kind of financial process, there are some inflows and outflows for the future, right? There are some inflows or outflows of cash in the future dates. And that projection of the inflows and the outflows at various points in time and future is what we call as cash flow analysis. So how better we are able to build those cash flows from the various investments, because in some cases the future cash flows are unknown. Like if I do a fixed deposit in a bank for 5 years, I will be knowing, I will know the day when I'll make the fixed deposit itself. It will mention what amount I'll receive on the maturity day after 5 years. So what is the amount I'll get in future, and after what period I'll get that money. So the timing, the timing as well as amount of the cash flows for the future are known in advance for some kind of investments. So these are known in advance, whereas in some cases, in some cases the timing and amounts are not known. That is where the whole complexity of the financial process lies. The timing and the amount of cash flows, like when now received, may not be known in advance. But of course, the inflows and the outflows, whatever I'm able to project for each point in time, we'll try to do the netting. So netting is nothing but the excess of the inflows and the outflows. So at the end of first year, what are my total cash inflows? What are my total cash outflows? Then the difference between the two is what we call as the net cash flow. If it is positive, then it's the net cash inflow. Otherwise, we'll say it's a net. Otherwise, we'll say it's a out. Otherwise, we'll say it is a net cash flow. So the very important job, like it is a very important in many organizations, because it's very important in companies, because it illustrates the real value of the firm. Okay, so this is very important. Okay, and so if the timing and amount of cash flows are unknown for so many investments, so investments are sometimes called securities, which is more like a tradable instrument. So we'll talk about this. So tradable is like, once I've gained a loan to somebody, right? And it may so happen that I will sell off this loan to someone else, okay, for one fixed amount. Now, because of that, what happens is I'm receiving money from this party, but now this party will keep receiving the principal amount and interest. Like that, every financial instrument, it has, to a large extent, the financial instrument, they have the feature of being tradable. Means if I have an old one right now, like one old security, like one bond or one security, I can very well sell it off in any of the markets and exit off that position. So that is what we are calling as tradability. Now, if the timing and the amount, both of them are uncertain, generally that is where we bring the row of probabilities. So we try to assign, like, there's a 30% chance of receiving 500 bucks. Okay, 500 bucks. Sorry about that. 500 bucks. But there is a 60% chance of receiving 1,000. There's probably a 10% chance of receiving 0. So the existence, if the cash flow is uncertain, we have such kind of probabilistic phase models, and we have got these probabilities which are generally designed on historical experience from the past data. And if the past data is not available, then it's similar kind of instruments or is securities of where this information is derived and tabulated. And here we can say the timing and amount. If the timing, see sometime, if the timing, sometimes we have the timings like, let's say this is timing, like the interest has to be paid annually, or in some cases we have a monthly payment. But in some cases the payment could be a daily payment. In case of microfinancing, where the interest payments could be either daily or weekly, that is very frequent. So we call this kind of payments models as continuous cash flow models. So it's easier to go with continuous. So continuous means very regular, very frequent time cash flows which are happening. So this is what is very brief introduction to the cash flows. Now we'll see for various financial instruments, very common financial instruments, what are the typical inflows and outflows which are associated with them. So to start with, we talk with a zero coupon bond. So we start with a zero coupon bond. Zero coupon bond cash flows. So as the word means, whenever we talk about a bond, it is nothing but it's a form of a loan. Okay, so it's a form of a loan issued by some government or from some corporation like big company for raising capital, okay, or borrowing. So instead of borrowing from the bank, so if you borrow from a bank, we classify as a loan. But if you borrow from public, that means multiple sources in small amounts, but total becomes very large. So so instead of taking a loan from the bank, they can issue a bond. So they can issue a bond and raise capital. Now the people who are investing in that particular bond are called as investors or holders of that bond. Now these people, as per the terms and conditions that are mentioned in the bond, these people may receive uh, whatever they have invested. See, at different points in time, let's say this bond is issued for 5 years, it may mention that at the end of each year some interest will be paid. Okay, so here we'll be paying some interest, and probably in the final year, which is at the end of 5 years, the face value of the bond will be refunded. So the bond here is quoted on the face value. Let's say a face value of, say, 1,000. It means that uh, on the maturity, on this particular date, uh, a value of 1,000 will be paid to the investor. Okay, so the face value is what, like, is the notional value of that bond, and if at all, if there is an interest at each period, that each interest at each, so this interest is called what? This is called a coupon. So if I say the coupon is 7%, means 7% of this face value, which is what? Which is 70, is received every year. So at each year you receive 70. Okay, and a face value of 1,000 is received at the end of every year, at the end of 5 years. So the payment wise, 70 will be received after the first year, 70 after second year, 70 after third year, after fourth, and 1,070 after the fifth year. Okay, now these are the inflows that are going to come. Whereas when it comes to outflow, whatever is being paid to purchase that bond, whatever the investor is giving to, whatever this investor is giving to the company, or whatever the price this bond is bought. Let's say you buy this bond at what, 975. So this is called as the what? This is called as the purchase price. Now what we're saying is this amount can be either less than, this can be less than or equal to or greater than the face value. If it is less than the face value, we call it as the discount bond. Okay, so if it's less than the face value, we call it as the discount bond. If it is equal to the face value, we call it as a par bond, and if it's greater than the face value, we call it as the premium. Okay, so if these periodic payments of 70 do not exist, and only the face value is paid on maturity, we call those kind of bonds as zero coupon bond, because the coupon is zero. Okay, at each of every intermediate intervals, there is literally no payment. Okay, so there is only one cash outflow and one cash inflow on the maturity date. No intermediate cash flows at all. So it is as good as a loan where they uh, along with the included interest is paid at the maturity date. So there are no interest payments. So for such kind of instruments, the negative cash flows happen on the date of investment. From the lender's perspective, there is a negative cash flow on the date of investment and a positive cash flow at the future date. But one thing we have to understand, today I've gained it and there is a negative cash flow. I've lent it and there is a negative. But there is no guarantee that I'll get this back after 5 years. So there could be some possibility, but I'm not sure. But there is some chance that this money cannot come back. And this is what we call as risk of default. So let's say I'm lending this money to the government. There is very less chance of default. I'll be very much assured that I'll get my money back. But if I'm lending it to a startup company, there is a very high chance that they may close down in the next few years and my money may not come back. So the risk of default in startups is much higher. And whenever the risk of default is higher, generally we see that the interest rates that are defined on them are higher, because high risk, the fundamental point is high risk of default. A high risk of default charge high return. Okay, so that is the only motivation to invest in that kind of security. So when I talk about a regular coupon based bond, which is 70 for 5 years, with along with the face value, which will have different cash flows at different points in time. But in case of zero coupon bond, all cash flows and the timing are well known in advance. Even in a coupon bond, as long as the coupon is fixed, as long as there may be scenarios of fixed coupons as well as floating coupon. So there may be scenarios where you have fixed coupon and floating. So in the fixed one, all the timing as well as the amounts of the cash flows are known in advance. So any bond or so there's just so these bonds can get traded, whereas a loan is just an agreement between a company. There is very limited chance to trade that. Whereas if a company has issued a bond and raised the capital through the public, that bond can be listed on a recognized exchange, which can be traded between the various parties. So, as I said, the holder of the bond will receive a lump sum face value on the maturity date, and along with some intermediate payments at periodic intervals of time, and the intermediate payments are called coupon. If the coupon is fixed, maybe so in some cases the coupon may be fixed or floating. So if the coupon is fixed, then the timing and amounts of the cash flows are fully certain. But if the coupons are floating, based on the prevailing interest rate at each of the periods, I may have to wait for each period to know what the interest rate is at that particular period, to understand how much amount to be received at that point. So there is a lot of uncertainty in those kind of payments. So typically we need to understand from the cash flows dimension whether that particular cash flows which we are receiving, the timing and amounts of them are certain or uncertain. If they are more uncertain, we can assign the probabilities and trying to compute the expected values and then proceed further for calculation purposes. And if they are more and more certain, then I can directly take the certainty values itself. So coupons in general are paid on an annual or semi-annual intervals. But even more frequently or less frequently, they may be less paid. So when I talk about a zero coupon bond, it's just a special case. It's just a special case. Just a special case where the coupon is what is equal to 0. Okay. So here the coupon is equal to 0 in the 0 coupon. So the cash flows which are associated with this kind of instruments, there is a negative cash flow on the date of investment, a series of small positive cash flows over the period of the loan, which are called coupons, and a large positive cash flow, which is the principal repayment or the face value repayment, which happens on the maturity date. And the price at which you are buying that particular bond, as I said earlier, it may be greater or less than or equal to the face value. If it's lesser, we call it as a discount bond. Equal to, we call it as a par bond, and the greater, we call it as a premium bond. So we have other kind of securities. So other kind of securities we have what? That are very commonly seen. They are called as indexed linked security. So the next one we look at is what? Is the index linked index linked security. So look at the index linked security. Second. So in the previous section, we look at the normal or the zero coupon bond. So these are fixed amounts that are fixed cash flows that are received at future periods and even on the maturity. Now, the fixed amounts which are getting received can be more or less based on inflation existing. If the inflation is very high, these amounts will be worth nothing. So let's say if my salary is 100, after 1 year my salary is increased by 5% and it has become 105. Whereas in the meanwhile, the price of the goods, which is a measure of inflation, has gone up by 10%. Suddenly, whatever I used to buy with $100 in the last year, that may not be bought with $105 because prices of goods have gone up. So my savings are going down even though my salary has gone up. My purchasing power or the value of my money is going down because of inflation. So that is what is trying to be addressed by this index security. So what index security does is the future payments. So the future payments, let's say this is a zero coupon bond, then we have these future payments. Yeah. So whatever the coupons or the face values, whatever they are going to be received in future, they are linked to an index, inflation based index, probably a consumer price index, which is CPI, or a wholesale producer index. They're all linked to this index. So if the inflation is high, the payments that are received will be higher. If the inflation is less, the payments that are received will be lesser. So in a way, that makes the cash flows more uncertain. I should be able to project what inflation will be at that point in time, and based on that, I should be able to predict the cash flows that will be received at that point in time. In a way, it makes the cash flows more and more unknown. So here, the only difference between the regular fixed interest and the index linked, the future cash flows are unknown. Okay, so both for the coupons as well as the face values, whatever the cash flows that are going to be received in future are going to be unknown. Though we know that they may be positive, but the exact value for those things may be unknown. So in general, we use the words, so in general, we use the words real cash flows. Reals means I am adjusting them for inflation. So here inflation is considered. And for the nominal, so for the nominal returns, inflation is ignored. Okay, so we have to really understand whether cash flows that we are talking of inflation included or inflation ignored. If the inflation included, like index linked security, so these are real cash flows. Where there's fixed interest, these are nominal. In real cash flows, if inflation is high, and vice versa. But one thing we have to understand here, one simple measure that needs to be understood is that interest or the inflation index. We said the coupons will be based on the inflation index. So suppose I have bought an instrument in 2012. So my first payment, let's say I'll receive it in 2013, 1st Jan. 1st Jan, this is when I've made the investment in 2012. So I received my first coupon in 1st January 2013. Then I'll be looking at, if I want to know the index, on this date, it becomes very difficult because the index calculation, that is WPI or the consumer price index, whatever index we're talking about, the computation of index is time consuming part. So I don't want to depend on the index at this level, but the majority of the investment, the index as on this date means the previous period. Probably when I'm getting my next cash flow, probably in 2014, I may depend on 2013 index. When I'm getting on 2013, I may depend on the index of 2012. The reason being, the index computation takes some time, and by that time I need my cash flows. I cannot wait for that. 2, the investor would like to know, at least in the next 5 years, but at least he should be knowing how much he'll be receiving in the next period. Okay, so he should be knowing, let's say index, so this period 1, period 2, period 3, period 4, period 5. So the investor will be knowing how much you'll be receiving in the next period. So to a large extent, for the index linked security, the index as of the previous period is taken as the base for computing the coupon as well as the face values that need to be paid out. Then the other set of securities that I can talk about, which everyone is comfortable with, is what? Is the cash on deposit. Is a cash on deposit. So if you look at the characteristics of the bank, if you look at the characteristics of the bank deposit, like the savings account. So the savings accounts as well as core does what? The core deposit. You can invest the money at any point, you can deposit the money at any point, and you can withdraw the money at any point. So there is no fixed index in the period, and at the same time the interest rates on your savings account, they can be changed at any point of the bank without any prior information to you. So the deposit which I've made today might undergo different interest rates at different points in time, which is not fixed for the period of your investment. It can change whenever the bank wants to. So, and you might be informed at a very small interval of time, but you cannot be given enough notice for that. So in a way, the amount as well as the timing of the cash flows is completely uncertain. But at the same time, in terms of the banks, there are also some terms which are called the term deposit. So these are more like fixed deposits. So for example, a fixed deposit is a term deposit, where at least you deposit something now, you will be receiving an amount which is fixed, probably after a fixed period of time. Okay, the only thing is that the interest rate is fixed, or it might be floating. So these particular instruments are non-negotiable. So I cannot exit out of my fixed deposit before the period. Let's say I've taken a 5-year fixed deposit. Okay. If I want to withdraw, let's say after 3 years, I cannot sell this instrument to someone else and get the money. But if it had been a bond, there is a market for selling the bond, and I can literally exit the bond after 3 years. But if it's for a fixed deposit, I cannot select or some other party at the end of 3 years and exit at the end of it. The only thing is that I can exit out of it by having a discussion with the bank and paying the price for it. I can very well try to exit of those fixed deposits. So that is the way the cash flows look like. For the core deposits, the amount and timing are not known, whereas with respect to term deposits, so we have core deposits and term deposits. For the term deposits, if it's a fixed term, fixed kind of amount, then the or not in advance. But if the interest rates are non-fixed, or if they can be redeemable when the party exists in point in time, the cash flows will become uncertain for those cash flows. Then what? Now look at what? Equity. Look at equity. Equity cash flows. So these are securities owned by the owners. So these are not like loans. Who will be paying the interest rate and the principal that on that? I'm actually investing in a company. So it's actually I've taken the ownership in the company. So if I'm buying like a share, that means I'm buying like ownership in a company. So there is no fixed amount. There is no fixed interest that I received on this. Instead, I'll be compensated with the share in the profit. So if the profits are high, I'll get a higher amount. If the profits are less, I'll get a lesser amount. And sometimes I may not get anything at all. So that is what an equity capital means. The amounts which I'm going to receive in the future, the timing which I'm going to receive, are all uncertain in an equity investment. The company actually pays dividends. So if the profits are higher, that means my share of the profit will be higher, and vice versa. But what could happen is that the company may pay out the entire profit, or may want to return some of the profits, especially if they want to fund new projects, or for compensating the years where poor profits are going to come up in future. So they may pay only some portion of that profit, and that is what we call as the dividend, and return the remaining portion for these kind of things. If the company wants to expand, or if a company wants to get into new projects or some new capital, so for that purpose it cannot borrow. So it can so happen that the profits of the existing investors are only returned and are used for funding the new projects. And if at all in a particular year the company did not do a particular well and got in some losses, or no payment was made to the investors, it retains some of these existing profits, so that even in a bad year some kind of payments can be made to the investors. So that makes the amount as well as the timing of the cash flows completely uncertain. And so the assumptions need to be made about the growth of the company in the future, which means the growth in the profits, or they can share the proportion of the profits increase for the investors. And the other important criteria with the equity investment is that there is no fixed maturity period. They are held until perpetuity. So these are held until they are held until perpetuity. Okay. So So they held until perpetuity. This means that until the company closes down, but you have the facility of redeeming them or trading them in the secondary market. So there is a secondary market that exists for the same. So you can think of trading them in the secondary market, especially if there's an exchange for the same, which is very liquid or very active. The trading can happen and you can exit out of your investment by selling it in the secondary market. Otherwise, the shares are held until the perpetuity. By focusing the amount and the timing of the cash flows, because in some cases the dividends can be made in twice a year, thrice a year, or every quarter. So the timing of the payment is uncertain, the amount of the payment is uncertain. So that is where the analyst has to focus more on predicting these cash flows so that a proper evaluation of that financial instrument can be done. But one more thing about the equity security is that in case the company is failing, the investor will get the share of the assets of the company only after the payments or by all the lenders and all the other liabilities have been made. They are the guys who get the last possession in the assets of the company. So it may be much lesser, or in some cases they may not get anything. They may not get any capital also. So that's why we call equity investment as a risky investment, because as long as the company is doing good, probably what they're getting is much more than what the lenders are getting. But if the company is not doing good, what they might be getting is much lesser than what the typical lenders are going to get. So those are the cash flows that are associated with equity securities. Then the other type of security we can look at is annuity. Annuity certain. Annuity certain. Which is more and more similar, which is similar to pensions, where I invest a lump sum today. After that, I'll be receiving fixed payments every year for some number of years. So the frequency which I'll be receiving, the number of years during which I'll be receiving, and the amount which I'll be receiving, all of them will be specified at the time of the beginning of investment. So there's a negative cash flow in the beginning and a series of regular positive cash flows over a period. But in some cases, this number of years over which this payment is done is uncertain because there might be a linkage with the survival of the person. As long as the person is alive, these payments will be received. That is a typical concept of the pension also. As long as a person is alive, he will be receiving the fixed payments, and it may be up to 110 years or 55 years or 75 years, whatever it is. So whatever the cash flows, the number of payments that will be received on that lump sum investment, they are uncertain. So that is what the prediction should have been based on. The mortality rate based on the mortality expectation, or some kind of predictions would have to be made with respect to the number of years the person will be alive, and based on that the payments can be decided. So this is one more challenging, uh, which has different characteristics with respect to cash flows. And one more dimension that is worth looking at is the loan cash flows. So in the loans, there are two concepts. One is I make a loan and I receive the interest regularly. I receive the interest regularly, and whatever the amount loaned, the loaned amount, I will get back at the future date. This kind of loan is called as the interest. This kind of loan is called the interest only, where at each period, at each interval, interest is being paid, and finally the amount that is loaned is refunded. So this interest only is a series of payments plus return of the principal at a future date. Similar to a fixed interest security, it is similar to a fixed interest security, but the only difference being, in some cases, the interest may be floating rate. Then the amount of cash flows is uncertain. And this kind of product may also have early repayment, which is also called as what? Prepayments. Prepayment. So it can also exist in this kind of a product. That makes even the timing of the cash flows may be uncertain. So if there is an early repayment, that means the whole principal is refunded at this point only. So in those cases, if one wants to get out of this loan, why should I have this burden of waiting for more years? So if he thinks like that, there is a possibility of doing an early repayment on the loan also, which will also make the timing of the cash flows uncertain. So which means from an analyst dimension, even the timing of the cash flows need to be assessed based on some kind of predictive models. The other normal kind of loan which we hear is the EMI based loan, equated monthly installment based. The bank will make a loan, but what will happen is that at regular intervals there is an equal amount that is being paid, which will include some principal as some which will include some principal as well as some interest rate. Whatever the payment is paying, it will have an interest portion plus some portion which is the repayment of the interest. So the principal is paid. So this is called as a repayment. It's called as what? A repayment loan or mortgage. Okay, so here there's just some partial repayment which happened. So if I add up the interest during any period, it comes down to an equal value. So that's why we call it as what? Equated monthly installment. And we know that the interest is only applicable on the principal that is outstanding. So in the first period, the full principal is outstanding. So the interest will be applicable on that amount. But in the first period, some principal is getting paid. So which means the principal that is outstanding, that is actually outstanding, is coming down. So because of that, the interest for the next period will become lesser and so on. But the overall payment that is being received is equal, which means as the time period increases, the interest portion of it comes down, but the principal portion of the loan goes up. And it is ensured that both principals and the interest added together will be a sum which is equal, which will be a sum which will be equal for the entire period. So that is the typical repayment law mechanism, where some portion of the interest and partial of the repayment happens. So in general, what we see as time passes, so what we see, the interest rate keeps coming down and down. The principal portion goes up and up and up, whereas the total amount that is being paid will always remain constant, which is the sum of the principal as this interest, which works out to some number. So this is a typical mechanism of a repayment long stop. As long as the interest rates are same, the cash flow inflows and outflows are fixed. But if the interest rates are variable, then probably the numbers are about to change over a period. So as far as these cash flows are concerned, it is very important for us to understand that whether the cash flows are fixed or variable, they are certain or uncertain, the amounts as well as the amounts we need to understand whether these cash flows are certain or uncertain. If they are uncertain, then what is the mechanism to predict those things, and what is the way we can assign these probabilities to these cash flows, because that's form the most important stuff to value any kind of investment position. So that is why we need to be very comfortable with, understand the cash flows of each and every investment, the timings and the amounts. If they are uncertain, how do we use the probabilities to arrive at the predictions of those cash flows? This concept has to be kept in mind when solving all the problems associated with the investments, right? So thanks a lot for listening to this session. Thank you very much.